They borrow money and they get paid. Who ever heard of this before? This is what Donald Trump recently asked when talking about negative interest rates. On this video, we're going to discuss what actually makes negative interest rates possible. And we're going to do that by contrasting how a normal banking system without central banks would work versus how our current banking system with a central bank works. In a normal banking system without central banks, savers are rewarded for providing capital to the economy. That is because when people save money and bring it to the bank and put it into a savings account, the bank collects all these savings and then lends them out again. They lend it to the government, to businesses, or to other people. Well, all these borrowers have to pay an interest to the bank for the loans. The bank takes a part of that interest and gives the other part back to the saver. So the result is that the savers get rewarded for providing capital to the borrowers. And in the system, the bank acts as an intermediary that manages the relationship between the savers and the borrowers. Well, what determines the interest rate at which all of this takes place? The interest rate is determined by the balance between savers and borrowers. If, for example, all of a sudden a lot of people and businesses need a lot of loans, but there is only very few people who are actually saving and thus providing money to be loaned out. So there's just a tiny amount of capital, but a lot of people who want to borrow that. Well, the bank, who wants to make a lot of loans, will increase the interest rate that it pays out to the savers in order to encourage more and more people to save and thus provide more and more capital so that the bank can give out more and more loans. Now, if it pays more money to the savers, of course, it also has to increase the interest rate that it pays out to borrowers. And this has two effects. On the other hand, as we've seen, the savers are encouraged to save, but the borrowers have to contemplate, do they actually really need their loan or can they do without? And both these effects create a balance again between the savers and the borrowers, or at least in the direction of a balance. And in the long run, bringing down interest rates again. If, on the other hand, borrowers all of a sudden don't need loans anymore, but there's still this huge amount of savers who are saving capital that could be loaned out, well, then the banks sit on a huge amount of capital which nobody wants to borrow. So what they do is they decrease the interest rate for borrowing in order to attract more people to take out loans, while at the other hand, decreasing the interest rate for savers because they don't need any capital, they can't even lend out the capital that they have. Again, rebalancing the relationship between savers and borrowers, and in the long run, interest rates will come up again. The result of that is not only that savers are rewarded for providing capital to the borrowers, savers are actually rewarded in proportion with the need of loans that is out there. Now, if you enter a central bank into the system, the entire mechanism that we've just been discussing is completely disabled. In a system with central banks, savers are actually punished. The beneficiaries are those who have huge amounts of debt. And who are those? Usually they are governments and big businesses. Now, why is that the case? Well, central banks don't depend on anyone for savings. They can just create or print the money that they want to lend out. And since they don't have to attract any savings and they can just print the money, they don't care at what interest they lend out this money. So if they want, they can lend out the money at little to zero interest. It doesn't matter to them. When they print the money, if they lend it out at 1% or 5%, it's the same to them. But what happens to the savers? Well, if the central bank lends out money at 0% interest, let's say, then the savers don't get any interest either, because the banks, who are still the intermediary, they have no reason to give any interest to the savers. Because why would they? They can just get the money for free from the central bank. So no reason to give the savers any money. But that's not all. Not only do the savers not get any interest, when the central bank prints or creates money to give out loans, it actually devalues the money that is already in circulation. And it does that through a process called inflation. So what's actually happening, what's enabling the central bank to just create money and loan it out is it is confiscating from the savers and from the population at large, and then gives these loans out at arbitrary rates, which it just comes up with. And in theory, it could even give out loans at negative interest rates. So far, this hasn't happened. The only negative interest rates that is being talked about in the news is usually the deposit rate with the central bank, but technically it could even give out loans at negative interest rate, and then it would just print the negative interest. But while the central bank could and does all of these things, the savers get hit twice. Not only do they not get any interest on their savings, the savings that they do bring to the bank actually loses its value. Now, I've heard some people argue that, well, savers shouldn't be stupid enough to keep their savings in cash. They should invest it in this or they should invest it in that. Well, in that case, I would just say, why is it the responsibility of the savers to make sure that they're not getting screwed? Well, I say it isn't, and they have a right not to be screwed with. So whereas in a normal banking system, savers are rewarded for providing capital, in the system that we have with central banks, savers are actually punished, and capital is simply confiscated from the population through inflation and then lended out at arbitrary rates. Or in other words, the central bank enables to give cheap loans to the government and big businesses by expropriating the capital from savers and the population at large. Now, if you would like to know how the process of expropriation through inflation actually works, I recommend watching this video.